time to focus on your retirement planning, steps that you can begin to take today. If you haven't done them already, David Stryzewski standing by, CEO of Sound Planning Group, to take a look. We've had a volatile market. We've had 2 great years, but it wasn't for the faint of heart sometimes, even now, right? We've had a wild ride, but some names have been so exciting and others have pulled back off highs. You actually have a very complete process with 7 steps. I'd like to hear them quickly so we have a chance to talk. Give us a glimpse.
Yeah, absolutely. Well, as people are approaching retirement, I think it's really important that you don't just have a portfolio that's called a retirement plan, but you actually have a real plan standing behind that portfolio. So our 7 steps essentially lay out like this. So step 1 is income planning. We have to figure out what your burn rate is. We need to figure out what you have, what you need, what you want. And a part of that's even a maximization strategy for Social Security. So people that are entering or near retirement, pay attention to that right there. Second is an investment strategy. Now, what got us here is not necessarily going to keep us going in the 21st century. We're seeing revaluations here. We need the right strategy, different portfolios from the accumulation phase to the distribution phase as well. Third is tax diversification. I'm calling this the Tax Cuts and Jobs Act 2.0, and ultimately the second greatest opportunity in our adult lifetimes to reduce or eliminate taxes is literally here right now. So don't just do asset diversification. We need to do tax diversification, Roth IRAs, contributions, conversions, etc. Next is healthcare planning, Medicare, whatever we're going to be doing for our healthcare as we retire. Very important to understand, especially if there's differences in ages between spouses. And so Medicare's had big reforms. There's ultimately going to continue to be reforms. Stay on top of it is very important. Our 5th step is real estate, whether it's your primary residence or you've got rental properties. Important things to understand, like Section 121, which gives you the ability to offset $250,000 per individual if you were there for 3 of your last 5 years of tax filings. So these are important ideas for how do we get after-tax money available to us right away. Number 6 is estate planning. We got to stay on top of that legal components here. I don't care whether it's a will or it's a trust. You need to have these documents in order, and it's very important to be reviewing them. And then the last step for us is that our ongoing review and evaluation process. And ultimately, the goal here is to figure out, what do you need to be tightening up and evaluating on a year-over-year basis with your advisory team in order to make sure you've got your fingers on the pulse of what's continuing to move on.
It's so hard to know when you actually can retire, when you actually have the financial independence to say, I'm done. To a certain extent, I'll use myself as an example. I feel like I'm going to work till I die because I'm not sure at any point that I will have enough to support myself, and my parents can't say enough. And you made this point, David, about how much doctors and healthcare cost. I think that was a lot more than they even anticipated, right?
Absolutely, Nicole. And, many retirees facing the future right now recognize that if we put on our 2020 vision, our 2020 glasses, we look at pre-2020, post-2020, where are we right now? The world's 26% more expensive. Very difficult to do when you're on a fixed income. You don't just, go and change, hours for dollars here. And so I think it's incredibly important, Nicole, not just to know what your top line number is inside of your portfolio, but ultimately the number is how much can you distribute at the end of the day and ultimately keep. And so we call this required rate of return that you need in order to achieve those lifestyle goals. And so it ultimately comes down to how much money do we need as an income. And so we got to start with a budget or a spending plan. If that's a swear word in your house, I get it. But ultimately, it is a very challenging thing. It takes some math and science, and there are ultimately 101 different ways to be evaluating our distribution process in order to create a more efficient withdrawal strategy. And so that's one thing that my team and I, spend 12 to 15 hours probably per family when we have an opportunity to sit down with all the details. It's a big deal.
They used to have a sort of a mathematical equation when, at least for New York City, okay? I don't know if this goes for the whole country. New York City's another animal. How much a guy should spend on the diamond ring for the gal based on his earnings or something. It's X percent of the next 5 years, and that's how much you should spend on her ring. Fast forward now, we're up to retirement. Is there a mathematical equation on how much you should have in the nest egg so that you can retire on time or whenever?
Well, a typical question is, how much should I be able to distribute? And so most financial advisors say, take the 4% rule as an example and take your total portfolio and you can distribute 4% of that per year. So let's just say that that's the number. The question is, what accounts and what amounts are you going to be withdrawing from each and every year in order to create the most efficient withdrawal strategy for the rest of your life? So there's after-tax accounts, tax-deferred 401k and IRA accounts, and then tax-free Roth IRA accounts. So what I want people to be focusing on right now is, how do we distribute into a diversified way so that when at the end of the day, when we're trying to take these dollars out, that we can ultimately keep more. So whether it's 4%, whether you think it's 5%, it ultimately comes down to the inflation world that we find ourselves in, and ultimately what portfolios should be able to yield. I don't personally like people going into retirement, though, if they have a higher than a 5% required rate of return. And the reason for that is we could see some negative years here in the upcoming years. And so simple math is, if you lose 50%, it takes 100% just to get back up to where you were before. I pray we don't hit any of these other crazy volatile timeframes, but in the event that we do, my goodness, it is important to make sure that we have our brakes in place, our anchors in place before we get to those timeframes, because that could really mess up a financial plan and a financial retirement.
Yeah, understood. Let's get to the picks here. You have Amazon and Barrick Gold. Now, with Amazon, I had on a couple of guests today who I know it's getting beaten up a bit on the heels of its earnings, but Arun Sundaram had a 276 target. Nick Jones at Citizens had a 285 target. Where do you think Amazon could be headed? It's at 229 today.
I mean, when we're talking about Amazon, I'm not looking at the next quarter or 2 quarters. I'm thinking about the future. And so I believe that they're going to be a very strong player. I mean, 300 Amazon, for sure, you're going to see this. These guys are an allocator unlike nearly any company in the world. They could have some challenges with some tariffs and some different things that are coming out with maybe some competition. But Prime is a growing area right now. They're doing really, really, really well. People are price shopping. And so in a price shopping economy, when you look at auto deliveries and that's a way to save money, I think that a lot of families are going to be, more focusing there as opposed to other companies that are out there. But additionally, these guys have been allocating into robotics. And that's ultimately been one of those big challenges, hey, it costs a lot of money to do robotics on the front end, but guess what? If you got the robotics, they can move faster. They're not more expensive as employees. AI potentially brings more sustainability. I think this is a strong multi-year play here. And so I think it's hard to find this kind of growth in this kind of scale in companies like this. So I'm a buyer on the dips. And ultimately, that's what my position is here today, is when we see a nice drop like 4%, I think that's a great place to throw some new capital in.
Right. So big picture. How about Barrick Gold? I mean, we are seeing gold itself, the commodity itself, at record highs. Tell me a little bit about the Barrick Gold story. Also a good long-term hold?
Absolutely. Right now, the world bankers just came in their 3rd year in a row, record gold purchases. And so this is not slowing down. In fact, if you look at the charts right now, I don't think that you're seeing anything stopping gold get beyond 4,000. And then ultimately watch for silver following that. The reason why I'm throwing Barrick Gold in here is because these guys are so significant and large. They're taking over more market cap. You got a North American player here that's doing some wonderful things. But these producers are way undervalued. We've talked about this in the past, and they've not actually had their moment of really beginning to shine like the gold and silver and other metals and such that they ultimately mine here. But I am a big believer. Their margins are great. When we got gold at these record highs like this, we're just going to continue to see improvement. And then ultimately, when we look at the world of blockchain and asset-backed things in this world, we're seeing a trend towards the tokenization of real-world assets. And I think ultimately we're going to see your gold and your silver and your oil and your LNG begin to get into this type of conversation. And so I think that we're going to really see these commodities grow as we're beginning to see a super cycle underway right now.
All right, David Stryzewski, great to see you, CEO, Sound Planning Group. Thank you, David.